Hello everyone, I am Dr. K. Poongothai. Today we are going to see about national income. National income is referred to as the total monetary value of all services and goods that are produced by a nation during a period of time. In other words, it is the sum of all the factor income that is generated during a production year. National income serves as an indicator of the nation's economic activity. National income is denoted as C plus G plus I plus X plus F minus T, where C denote the consumption, G denote the government expenditure, I denote the investments, X denote the net exports, that is exports subtracted by imports, F denote the national residence foreign production, D denote the national residence domestic production. Business cycle. A business cycle is a cycle of fluctuations in the gross domestic product GDP around its long term natural growth rate. It explains the expansion and contraction in economic activity that an economy experiences over time. A business cycle is completed when it goes through a single boom and a single contraction in sequence. The time period to complete the sequence is called the length of this business cycle. The boom is characterized by a period of rapid economic growth, whereas a period of relatively stagnated economic growth is a recession. These are measured in terms of the growth of the real GDP, which is inflation adjusted. Inflation and deflation. Inflation occurs when prices of goods and services rise too much too quickly, while deflation occurs when those prices decrease. The balance between these two economic conditions, opposite side of some coin, it's delicate and an economy can quickly swing from one condition to the other. Balance of payment. The balance of payment BOP is the method by which countries measures all the international monetary transactions within a certain period. The BOP consists of three main accounts: the current account, the capital account, and the financial account. The BOP is based on the principle of double entry bookkeeping, meaning that every transaction is recorded twice, once a credit inflow and once as a debit outflow. This ensures that the sum of all transactions or the balance of payment is always zero. Monetary policy. Monetary policy is the control of the quantity of money available in an economy and the channels by which new money is supplied. Economic statistics such as gross domestic product, the rate of inflation, and the industry and the sector specific growth rates influence monetary policy strategy. Monetary policy is a set of actions to control a nation's overall money supply and achieve economic growth. Monetary policy strategies include revising interest rates and changing bank reserve requirements. Monetary policy is commonly classified as their expansionary or contractionary. Fiscal policy. In economics, a political science, fiscal policy is the use of government revenue, collection, taxes or tax cuts, and expenditure to influence a country's economy. The use of government revenue expenditures to influence macroeconomic variables developed in reaction to the Great Depression of 1930s, when the previous laissez-faire approach to economic management became unworkable. Fiscal policy is based on the theories of British economist John Maynard Keynes, who Keynesian economics theorist that government changes in the levels of taxation and government spending influence aggregate demand and the level of economic activity. Fiscal and monetary policy are the key strategies used by a country's government and central bank to advance its economic objectives. The combination of these policies enables these authorities to target inflation and to increase employment.
So, here we shall also know how this fiscal policy works. Government taxations, spending are the primary tools used to conduct fiscal policy. If the government lowers taxes, for example, it can lead to an increase in consumer spending, that is consumption, and the business investment. These factors can stimulate the economy. Government spending on public works can also help boost economic growth. If the government increases taxation to generate more revenue, or reduces its spending, both can slow economic growth as well as the possible leading to an contraction of regression. There is also three types of fiscal spending, that is mandatory spending, decentralized spending, and also supplementary spending. Thank you.